So obviously the key question on the minds of investors is how to deal with the current situation. How should they react? Should they react at all? And let's just think back to the global financial crisis. I mean, that would have been a very difficult period to stay invested, but it still would have been, for most people, the best course of action. It's a very difficult time, and we don't know if markets have bottomed. We've seen a strong rebound at the early part of the second quarter. But one of the things that can make it perhaps a bit more palatable for investors to remain invested is looking at valuation, because with the sell-off that we've seen since the back half of February, the valuations of the market are now back to median levels. So we're not at the fire sale levels that we saw at the bottom of the global financial crisis, but we have returned to a level in line with a 30-year median Shiller PE. And the Shiller PE is a measurement that looks at average margins and just kind of it smooths out the variations that you get through these sorts of disruptions. And obviously, earnings are going to be significantly affected through the remainder of the year, but investors will tend to look through that to what happens once the recovery is in place, and the Shiller PE helps do that a little bit more easily than just looking at what nominal PEs might be.
As we go into the second quarter, there is still a lot of uncertainty about how severe the impacts will be to the economy and also to corporate credit. Given this fact, we're really viewing credit with increased scrutiny due to heightened risk of downgrades and unprecedented economic challenges that lay before us. Really, as investors, our goal is to invest through cycles. Our security selection and process really emphasize governance, resiliency, and sustainability characteristics. However, we are looking at each credit within our funds with increased scrutiny, focusing special attention on corporate liquidity and flexibility. We as investors must be highly vigilant during these times of volatility, and this includes looking for select opportunities in the form of excellent but mispriced bonds.
March 27th marks the 5th anniversary of the Sustainable Funds. We want to thank our investors. We find that the integration of ESG is not just a values-based aspect. It helps us dissect and eliminate issuers that are not demonstrating best practice standards, but more importantly, identifying companies that are demonstrating those practice standards that we find are better positioned in the economy. Regardless of whether it's a portfolio that has sustainability or not, all investments are subject to the environment they're exposed in. If it's raining, it's likely we're going to get wet. If it's snowing, we probably get snowflakes. And in this particular experience, extraordinary market volatility. And so at this point, what we're doing is identifying means of how to retain portfolio flexibility throughout this uncertain environment.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting www.saturnaSustainable.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Saturna Sustainable Funds and a free prospectus or summary prospectus, please visit www.saturnasustainable.com or call 1-800-728-8762.